Hi, this is Mr. Evans. This video is going to look at profitability ratios, and the three profitability ratios you need to know are listed in the specification here. I'm going to go through each one of them in this short video. So this is a very basic income statement. I've gone through how this works, but essentially to work your way through the different types of profit you need to know, you start with total revenue, you take off your costs of production, and that gives you the company's gross profit. You then take off the expenses, the fixed costs, that will give you the operating profit, sometimes called net profit. And then you take away any taxes, interest payments or other one-offs to get the profit for the year. But as I said in the last video, these raw numbers aren't necessarily a great guide to an organisation's performance. It can be more beneficial for shareholders or the management or other stakeholders to consider an organisation's profitability rather than the actual profit figure that they make. Well, why is that? Because these profitability calculations look at the efficiency at which an organisation is controlling its costs. And if an organisation can control their costs, that's an indication that they are likely to be more profitable in the future. They're going to turn more of that sales revenue that they're generating into profit if an organisation can control its costs well. So there's the definition of gross profit. It's a measure essentially of how efficiently a business is controlling its variable costs of production, like its raw materials, its packaging and delivery costs. So in this case, we can see that the business makes total revenue of 950,000 and 550,000 of that are variable costs of production, these sorts of costs here. Now, when we take that 400,000, how much of that 950,000 did we actually turn into gross profit? Well, we can work out a percentage if we take the gross profit, 400,000, divide that by 950,000, and that gives us a figure of 42.1%. This means that the organisation's gross profit margin is 42.1%. In other words, for every £1 this organisation takes in sales, they're converting 42.1 pence of it into gross profit. Well, is that very good? It's difficult to tell, to be honest. We'd want to have a look at what they did last year and whether this is an improvement or not. We'd want to have a look at what their competitors are doing before we make a judgment as to whether this is any good or not. Once we've had a look at the gross profit margin, well, that was only our variable costs of production. We want to now take off our fixed costs of production to give an idea of how the business is performing, and that will give us our operating profit. Now, this organisation has incurred £300,000 worth of fixed costs. Those fixed costs could be any of these things here. To give us the operating profit figure of 100,000. So what are we looking at now? We're looking at how efficiently a business is controlling its total costs of production. Now, I often think about, and business analysts will look at the operating profit and the operating profit margin as kind of, these are the core activities of a business. In a way, this is more important than the profit for the year in terms of the business's performance, because this profit for the year figure can be manipulated, can be affected by kind of one-off payments that may not occur in the future. Whereas this is the primary measure of business performance. How effective is an organisation at taking total revenue, not incurring too many costs in production, and turning that revenue into profit? So the operating profit margin is very, very important. And in this case, this organisation has made £100,000 net profit on total revenue of 950. That gives 10.5% operating profit margin when we put those figures into the formula here. So what does that mean? Well, it means that for every £1 they take in revenue, they're converting 10.5 pence of that £1 into operating profit. Now again, is that any good? Well, If you look at the past performance of the organisation and what their competitors are doing, that will give you a better indication of whether this is any good or not. But obviously we're looking for the highest figure we possibly can here. We want to make as much profit as we can on that revenue that we take in. The final figure that you need to know is the profit for the year ratio. And the profit for the year is calculated after we've got our operating profit. Then we might take tax, interest payment, and any other one-off costs that occur, i.e. the purchase of assets or the sale of assets, that could add or subtract from our profit for the year. That's why this ratio isn't necessarily the best way of measuring an organisation's performance year on year. Maybe if the organisation has bought a big fixed asset over the course of the year, that's a one-off cost that might appear here and skew the figures. Equally, if they sell a really important asset, that might make the profit for the year look really good, but they can't sell that asset again in the future. So the profit quality tends to be higher when you look at the operating profit. Nevertheless, it's the same formula every time. You divide the profit by the sales revenue and multiply that by 100 to give a measure of the efficiency by which a firm is controlling its costs, the business is controlling its costs. In this case, 75 divided by 950 gives a profit for the year margin of 7.9%. So I hope that quick video has helped you know how to calculate profitability ratios and to know why each one is important. Key thing, to make sense of a profitability ratio, it helps to look at past performance data and how their competitors are doing.